Hello, clients, friends, and colleagues. This is Richard Siegel with ARQ Wealth Advisors. Today is Wednesday, July 22nd, and this video will be an overview of our Q2, our second quarter commentary. So let's get right into it. Okay. Essentially, the second quarter was one for the record books. A tremendous recovery in the markets. The markets in general have formed the coveted V-shaped recovery here. What that basically means is the market has recovered most of the losses that we experienced in the traumatic drawdown that happened based on COVID and the economic shutdown. You'll notice here that in the first quarter, stocks were down about 22% on average. The worst of it was about 35%. But as soon as the Fed stepped in around the end of March, backstopping the credit system and creating the CARES Act, essentially the market took off from there and finished down about 22% in Q1, and then a nice follow through about 20% in Q2. These indexes here, there's four of them: the U.S. S&P 500, the Dow Jones, the foreign developed markets like Europe and Japan, that's the orange, and then the emerging markets, which is this lavender color here. Okay. The recovery really is based on ameliorating the fear of an economic disaster, deaths due to the virus, etc., shutdown of the economy. Now that a lot of that is beginning to improve, we believe that the stock market will need to see some real fundamentals to maintain these levels. This is the same chart here in a linear format, and you can see here that the drawdown was much steeper than the recovery. This is about twice as long to get back. We're not quite back to where we were yet, but we're on our way. Economically, things have improved. We're definitely in a recession here. By all accounts, the second quarter will be a horrible number, economic contraction. It could be in the 30 to 40% range. Our first quarter GDP was negative 5%, right over here, but we really didn't lock things down till the beginning of March. So that number there is really just for a few weeks of the quarter. The second quarter will be much more significant. This chart over here is really interesting. It's called the City Economic Surprise Index. This benchmark's been around for decades. And basically, it's looking at high frequency data, rolling 1 week data. And if there was no surprises at all, what you'd see is a line right over here across the zero, basically, right? Like this. No surprises. All the consensus estimates are correct. That's not the case. So we had a tremendous drawdown here, a huge surprise to the downside, and now a huge surprise to the upside, meaning that some of the data has been coming in better than anticipated. That would include things like auto purchases. The housing market's been very strong. Consumer confidence is better than expected. Unemployment is horrible, but not nearly as bad as anticipated. It was supposed to be around 20% in May, and now we're sitting at about 11%. So it's not good, but definitely much better than the worst case scenario. Obviously, there's been some winners and losers here. The losers primarily would be in the travel and leisure, tourism areas. The winners, I would say, would be technology, communication services, just for an example. Okay. As we get closer to a vaccine and better therapeutics, I think the areas that have experienced the greatest downside will have the biggest upside potential. Okay. As far as the broader strokes of the economy here, what you'll notice is this number here is through Q1 GDP. This will come way down. By all accounts, what you're probably looking at is a pretty good sized rebound in economic activity and growth in Q3. And if that does happen, and the consensus is for double-digit return to economic expansion in Q3, if that does indeed come to fruition, this will be the deepest and maybe shortest recession in our country's history. So think about China for a moment. China, they locked down earlier than we did, in January, in fact. Their GDP was negative 7% plus for Q1. Their Q2 number just came out recently at positive 3.2%, which means really that that's not even a recession. A recession is defined as 2 consecutive quarters of negative GDP. So what we're seeing in some of the Asian countries is that they're actually opening up and the economy is turning around, and they're handling the virus a little better than the US is as far as containing the spread and the amount of fatalities. Okay. You'll also notice here that consumer confidence cratered. It's making its way back as people get back to work, as they have received pretty generous unemployment benefits. They feel more confident in cash flow. Okay. As far as the markets go, the equity markets, I think this is just a great example of why it's important to stay the course. It's textbook. Panic is not an investment strategy. Obviously, if you could avoid drawdowns, that's ideal, but nobody knows when the bottom is or the top is. So essentially what you want to do is to create opportunity when there's tremendous volatility, meaning to lock in profits when things go straight up, sell high, and when things tank, even though it's counterintuitive and it feels like it's never going to end, you need to kind of hold your nose and add to your stock positions. We did some of that for our clients in March, April, and May in order to maintain allocations. And then during the recovery, clients have done quite well by having their equity exposure intact. Okay. Now the question is, how is the stock market doing so well considering the economy is in recession, people are out of work, businesses are going under? And the answer, really, the simple answer is that the economy and the stock market do not move in lockstep. They are two different things. Now, generally speaking, the stock market is a reflection of economic conditions, but they could dislocate for long periods of time. Think about 2009. That's the end of the credit crisis, the Great Recession, and the market bottomed in March. Okay. But the recession didn't end till the fall. So the market tends to turn up several months before the end of a recession. And that's what's happened here. Okay. Additionally, economic data is backward looking, and the stock market is looking at forward earnings guidance by companies. So they're not the same thing. Okay. Additionally, when we talk about the stock market, let's focus on the biggest news in the market is these Fab Five stocks, right? Amazon, Microsoft, Google, Facebook, and Apple. Huge companies, all tech-based. And they become so big and so dominant with so much market share that they now represent almost 25% of the market capitalization of the S&P 500. That's a little dangerous. Kind of reminds me of the tech bubble. Now, these companies are great companies, and they can go higher, of course, but their valuations look out over their skis. For example, Microsoft is trading at 32 to 33 times forward earnings. That's very high. Apple is trading in that range too. Amazon's trading at 140 times forward earnings. So they're great companies, and we all use them. We have to use them. But just keep in mind that at some point, they'll either come down or they won't really move higher for a long time. They'll grow into their earnings, perhaps. When the market has a tremendous trough like it has and then recovers, what you tend to find is that the economically sensitive sectors outperform, i.e. energy, financials, for example. And that's what's kind of happened here. You can see in the second quarter, this chart, the best performing areas have been small cap stocks. That's the Russell 2000, up 25.5%. The Dow is up 18.5%, the S&P 20.5%, and then the equal weighted S&P, which I like to follow that as well. That's all 500 stocks, equally weighted, up 21.5%. Okay, foreign stocks have done quite well also. Fascinating to see what happened here in May. The dollar started to get weaker versus other currencies. Think about this. The government has created so much new cash out there. The money supply, the M2, it's over, I think it's 20 or 25% more money today than just 5 months ago. It's amazing. Okay. So as there's more money out there, the value of that currency has dropped. So as our currency has dropped slightly here in May and June, you see this parabolic move up in both developed and emerging foreign markets. Okay. So in June, for example, the emerging markets were up 7.35%. Europe, Japan, Australia up 3.4%. The Dow and the S&P and Dow are up about 2%. So we did lag in the latter part of the second quarter. Okay. Today, our portfolio strategies are allocated approximately 70% US, 30% foreign, and of the foreign exposure, roughly 2/3 are in developed markets and about 1/3 are in the emerging markets, primarily in Asia. Okay. Broadly speaking, okay, stock prices today are trading at elevated levels to historical averages, but the 10-year Treasury is yielding about 0.6%. Cash is yielding 0%, and the Fed has indicated they have unlimited support at this point. That's also unprecedented. So there's an old saying, don't fight the Fed. The people that are printing the money are telling you that they're not going to raise rates for 2 to 3 years. So if you want to make any money really, then you have to invest in risk assets. That would primarily be the equity markets, perhaps real estate, high yield junk bonds, etc. Looking at the fixed income markets, for the first quarter, really the panic trade was to plow money into cash and treasuries. Treasuries did quite well. Everything else had a horrible quarter. So junk bonds, investment grade corporate debt, municipal bonds, etc., were all down in the first quarter. Once the Fed came in and they backstopped the credit markets and basically started buying or promising to buy these bonds, the risk of default was almost off the table completely. And you saw the second quarter, just the opposite happened. Treasury bonds were relatively flat here, about 0.5%. Everything else was greatly outperformed, has greatly outperformed. So the bond market, ex Treasury bonds, has fully recovered from the panic selling that happened in February and March in the first quarter. We also like investing in what we call non-traditional alternatives. These are essentially hedge fund-like investment strategies. For example, merger arbitrage, convertible arbitrage, covered call writing, etc. They tend to have bond-like volatility and risk without any of the interest rate sensitivity. So you can see here in the second quarter, okay, those treasury bonds up 0.5%, municipal bonds up about 2 3/4. The basket of assets that we like to use, those non-traditional assets, up 4.4% in the quarter. And finally, the corporate bond market. This is the investment grade corporate bonds. Okay. Think of like big time, like Microsoft, if they issued a bond, for example, up 9%. So a great recovery in the fixed income space. Today, looking forward, if you like the idea of getting 0.6% for a decade, then treasury bonds might be a good place for you to be. We think it's a horrible long-term investment. So that being said, we still prefer the municipal space, the medium grade, investment grade space, yields in the 2 to 4% range instead of 0.5%. And we love the idea of having exposure to this non-traditional space that has very little correlation to stocks and no correlation to the interest rate markets. Okay, so to kind of wrap things up, as we head into the second half of the year, there are sure to be setbacks. We've seen a few already. California is shutting down some of their businesses again. The market already kind of knows this. We're also moving into one of the most contentious, if not the most contentious election in the country's history. On a positive side, vaccines look like they're really on the horizon here. There's over 100 companies racing to get this done, and a few of them are the front runners. There'll probably be something by the end of the year and mass distribution sometime in 2021. That's great news. There's also therapeutics out that are helping patients to avoid dying on ventilators. So things like steroidal and antivirals are helping to reduce inflammation. This is all very positive, great news, and it's happening historically at light speed. Okay. Regardless of who wins this election, the U.S. is resilient. We will move on. No matter what your politics are, companies will still make profits. They'll still innovate. Okay. At the end of the day, the stock market is a reflection of corporate profitability. Okay. We think that the major shocks are way behind us. Okay. The market seems to be in a trading zone at this point, understanding the pricing in the pending election cycle, pricing in the rolling shutdowns, pricing in school shutdowns. Everything that you're reading about and you understand is already being priced into the stock market today. Okay. The last several years, this is probably the best time to be ultra diversified. If you load up on large cap growth stocks like Amazon, you might continue to do well, or you could lose a lot of money. We like the idea of having exposure to mid and small cap stocks and value sectors and overseas and a variety of bond and low risk holdings. Okay. So with that, we'll wrap up. I hope you found this helpful. Please stay healthy and we will speak to you soon. Thank you.